This nation was founded on the principle that all men are created equal.
We hold these truths to be self-evident.
That all men
are
created equal.
I'll tell you what freedom is to me. No fear. I mean, really, no fear.
Created equal.
From WDET in Detroit, this is Created Equal. I'm Stephen Henderson, and I'm in the studio with Carrie Jr. II, who is the show's producer. Hey, Carrie.
How you doing, Stephen?
So, Carrie, when's the last time you went to a bank branch, went in, saw a teller, conducted your business?
2 or 3 years by now. It's been years. A long time.
And you live in the city like I do.
You don't need it.
If you were going to go to a bank in Detroit, how close would it be to your house?
Well, to my house, it'd be pretty close. But I've been to other parts of the city, and access to that type of experience, being able to see someone in person, sit down, don't believe it's as accessible.
Yeah, it's not as accessible, and it's dwindling, right? We're losing bank branches in Detroit. And it's an issue because people need access to not just the banking, the holding of their money in a bank, which is part of stability and wealth building, but they also need access to lending, right?
Yeah.
You need a car loan, you need a home loan. In many cases, you need smaller kinds of loans to make things just kind of go okay in your household. And that's what we want to talk about today, is that rarity, that scarcity of banking in urban environments like Detroit. We have a guest, a journalist, Oscar Abello, who's been covering banking for a really long time, and he's working on a book about what some of the problems are, but also one of the solutions that he really focuses on, and that's the idea of state governments starting their own banks as a way of providing capital that allows local banks, community banks, local banks to survive more and lend to people in tough environments.
Yeah, Oscar Perry Abello, he's a senior economic justice correspondent for Next City. Economic justice meaning, he's looking at how local communities can find ways to sustain themselves. And one of the ways that he says, as you alluded to, or as you stated, is state banks, but also local and community banks that are smaller that may be able to give you more loans that national banks can't. So we talk about access. We're not talking about going into the building.
Right.
We're talking about how much more likely are you to be able to get money from the bank.
Yeah, and
start a business.
It's both, right? It's accessible in the sense of physical accessibility, but it's access to the capital.
Right.
The national banks like Bank of America or Chase, which are two of the bigger ones, but especially they're not in the business of making the kinds of stopgap loans that a lot of people, middle and working class folks, tend to need. And so there's got to be something that kind of steps into that void to be able to do it. And right now, it's payday loans, which is a predatory and dangerous practice. We want to ask Oscar about that, of course. But this idea of a state bank, why does that work? How does that work? And is that something we should be thinking about in states like Michigan? Oscar Perry Abello, welcome to Created Equal.
Thanks, Stephen. Great to be with you.
Yeah. So I want to start with a premise, and you can tell me if I'm wrong about that premise. It seems to me that from your point of view, and given the work that you're doing, you believe that there's something really off or maybe even really wrong with the banking system in our country. Let me know if that's the case, and then tell me why you believe that's true.
Yeah, so in my reporting over the past couple of years, I've been with Next City since 2015, and I've been really focusing on access to capital and credits for most of that time. And you can look at all different ways of measuring it, but the fact is there's more demand for small business loans, for home mortgages, even just for personal loans, to help out for when a car breaks down or with medical bills that unexpectedly pop up every now and then. And there's more demand. than the banking system has been able to provide over the past couple of years. And when I say the banking system, I really mean specifically banks,
Yes.
right? Which is why you see other alternatives popping up, like payday lenders and pawn shops and other predatory kind of lenders popping up across the country to fill in those needs that are much more expensive than what banks have been able to provide historically. And there are any number of reasons for that, which we can talk about. I'm sure we'll talk about why the banking system really hasn't been able to provide meet those needs in the way that maybe it used to. And remember, I should also caveat this by saying the banking system has never been equally accessible to everybody. And I think it's been becoming less and less accessible, even to communities that used to have much greater access to the banking system, let's say 30 or 40 years ago.
Mm-hmm. And when we say that there's this incredible demand for credit and the banking system is not able to meet that demand, let's talk about why that's true. What is it about these requests for credit, who they come from, where they're located, that is beyond the reach, the willful or just kind of static reach of the traditional banking system?
Yeah, so the size of the loans or the loan requests are one thing, right? So a lot of whether it's consumer loans, someone who needs just $300 or $400 to help pay for, car repairs, or someone is looking for a small business loan, a new small business loan for, $30 or $40 or $50,000. The bigger the banks get, the less interested they are in making smaller loans. There's lots of different researchers that have looked at that problem, at that dynamic over the years, going back to even before 2008, even before the 90s, and before the 80s. The bigger the banks get, the bigger the bank is, the larger its loans tend to be. And so we used to, in this country, have a lot more smaller banks around that were able to and interested in doing those smaller loans. In 1985, the year I was born, we had 15,700 community banks across the country. We had 15,000 credit unions across the country. Today, we have about 4,000 community banks and about 5,000 credit unions across the entire country.
Wow.
So we have fewer institutions, dramatically fewer small institutions interested in making these smaller loans and using their knowledge and relationships in the community as part of their decision-making process to make these smaller loans.
Yeah. And so let's talk about the flip side of that, which is what has come in to fill the gaps, as you say, these kind of payday kinds of loans and stopgap kinds of institutions. Let's start with what's wrong with that system. You described it as predatory. Tell me why.
So payday lending didn't really exist in this country until the early to mid 90s. And these would be lenders who come in and with very little underwriting. So they don't, they weren't really looking at like how much money you made. They just sort of said, do you have a job? Okay. And, we'll make a loan to you for $200, $300, $400, and we'll charge you 100, 200, 300% interest on those loans, because you're in a bind. You've got to pay your car repair bill so you can get to work. You've got to pay your medical bill so you can walk. You're in a bind, and so you're not really looking at the paperwork. What you really need is just speed. You need the money fast and quick. And these lenders were able to just put a bunch of money out, a bunch of little loans out, charge a massive amount of interest. And it became a business model that was very successful for these small companies that became bigger and bigger and bigger companies over time. So they charge a lot of interest. They do work very fast. But the cost of it is they charge a lot of interest. And they would work out a system where like you could pay back the previous loan with a new loan
Right.
and just keep on paying loans and paying interest on those loans for weeks and weeks on end. Usually, the idea with a payday loan is, you take out a couple $100, and on your next paycheck, when it comes into your bank, they take out what you get paid. They take out the payment. Not everyone's able to do that. Not everyone's able to make the full payment, and so you just end up paying, on and on and on, and paying several times more in interest than what you would actually borrow.
Yeah.
In the end, and just get trapped in this cycle of debt.
Yeah, you dig a deep hole that it's impossible to climb out of.
Yeah, and that's sort of the predatory nature of it, is you get stuck and certain borrowers, and they would primarily be low income borrowers, working class folks who would get stuck in these cycles of debt.
Yeah. So I also want to talk about the borrowers. Traditionally, when we think about banks and loans, we think about two items up front, right? Your car, your house. Most people in their lives won't have a lot of other occasions necessarily to go get those loans. But with these payday loans, we're talking about people who need cash for other things, for everyday living, just to fill the gaps in their ability to get food, or to keep gas in the tank of the car that they might have borrowed money for. Can we talk about the evolution of that need that also kind of accompanies the growth of these national banks that aren't interested in meeting that need?
Yeah, so a lot of financial literacy experts or professionals, they typically say or recommend having a few $100s set aside in emergency expenses.
Mm-hmm.
Or I should say, the idea is, if you don't have $300 or $400 set aside for emergency expenses, something like a car breaking down or unforeseen medical expenses can put you into poverty. And the decline of all of those small banks that used to be around in every neighborhood of the country,
Mm-hmm.
almost every neighborhood, started in the 90s, around the same time that the payday lending industry started. They kind of jumped in almost immediately as all these little banks everywhere started to fade away. The payday lenders kind of jumped in and took over that space. And that need was basically, I guess what I'm saying is, those little needs were always there.
They were always there. Okay.
And they were always there, and and all those little community banks or credit unions, or we used to have savings and loan associations that started out in home mortgage lending, but they really evolved into being consumer banks.
Mm-hmm.
And that need was always there and could be served locally and affordably. And someone in the community wasn't looking to put their own neighbors into cycles of debt. They wanted to give them what they needed. Oftentimes, when there were so many community banks or credit unions around, it was someone with a home mortgage who maybe needed an emergency loan,
Mm-hmm.
just to tide them over for a week or a month. You didn't want to put that person into a position where they're constantly in further and further debt. They're already trying to pay back a home loan, so you didn't want to destroy that person financially. When those relationships started to break up and all those little community-based financial institutions went away because they were bought up by big banks, that's when the payday lenders would jump in, and the payday lenders don't really care. Their business model isn't made on helping every household or business become self-sustaining over time. Their business is based on how much interest can I extract from your paycheck every week.
Yeah. Your solution, or one of your solutions to all of this, is more community banking, but also the idea of a state bank. And I want to give you a chance to talk just a little about what that is. I don't want to get to specific examples quite yet because we're going to do that in the next segment, talk about the one real state bank that we have in the United States. But first, just tell us about what you see as the virtue of that approach and why it's an answer to the things we've just been talking about.
It really starts at the local level, right? So what I've learned in my reporting over the years is that there is still this need for locally based, non-predatory financial institutions that are accountable to each community, that know each community, that each community can hold accountable in some way.
Mm-hmm.
Either because it's a credit union or it's locally owned and the owners are part of the community and they're not looking to put their neighbors into poverty. That's something that worked in this country for not for everybody, but for many communities for a very long time. The state-owned bank can, depending on how it's structured, can provide a lot of support to those local financial institutions, whether they're community banks or credit unions. There are all kinds of little ways that those institutions can partner with a larger bank that isn't looking to steal their customers, right?
Mm-hmm.
That's the key with having a state-owned bank that holds deposits from the state government, is that it's not looking to take the clients away from the little banks. It's just looking to help the little banks and credit unions do more of what they want to do, what they need, their communities need them to do.
Okay, we're going to take a quick break, and when we come back, we're going to continue this conversation about banks and access and the solution to getting more people availability and access to banks. Stay where you are. We'll be right back with more Created Equal. You're listening to Created Equal from WDET in Detroit. I'm Stephen Henderson. We're talking with Oscar Perry Abello. He's a senior economic justice correspondent for the urban magazine called Next City. He's also writing a book about locally owned banking institutions. We're talking about banking, how hard it is in cities like Detroit to get access to banking for so many people, and what some of the solutions might be to that lack of access. Oscar, I want to start this segment talking about the solution that you were just talking about at the end of the last segment, which is this idea of a state bank. I think when you say that term to most people, they have no idea what you're talking about. They've never heard of it. We do, however, have a citizen here in Detroit who is a listener to this show, who whenever we talk about anything in terms of financial institutions or financial access, he gives us a call and lets us know about the idea of a state bank. He's a really big fan of the idea. His name is Chris. I hope he is listening as we have this conversation. But I want to have you talk about the one state in the union that actually is trying this and has been trying this for some time, and I guess how it works, how it affects this lack of access that we see in places like Detroit or Michigan or other states in the union.
Sure, Stephen, great to be with you. Thanks again for having me on. So the funny thing about North Dakota, where you have the one state-owned bank that's been in operation for 100 years. The funny thing about it is most people in North Dakota either haven't heard of it, or if they have heard of it, they don't necessarily realize it's a state-owned bank.
They don't even know.
And that's because of the way they don't even know. They may not even know that it helped them unless they ask about it. Mm-hmm. I'll give you an example. When I went to Fargo in 2019, in December of 2019, it was winter, it was snowing, it was very cold. I think the high temperature was minus 7 degrees. But I went to an international grocery store, FM International Grocery Store, owned by two immigrant gentlemen in Fargo. And I had heard from another immigrant entrepreneurship group in the Fargo area that they had helped these guys get their grocery store started, and then eventually to buy the building where the grocery store is located. And I was like, that's amazing. How did they buy the building? Oh, they got a loan from Cornerstone Bank, so we helped them get the loan. Cornerstone Banks is a community bank based in Fargo.
Mm-hmm.
And so, I went to the grocery store, talked to them. They were like, yeah, Cornerstone was great. It was nice working with the immigrant entrepreneurship group. We got the small business loan for $250,000, and we bought the building and all the equipment too. It was a pre-existing grocery store, so it had all the freezers and refrigeration and all the equipment inside. They bought all of it, and they were paying less on the mortgage than they were paying in rent before. Okay, so great. So I went to Cornerstone Banks. I went to the community bank, and I said, hey, you make small business loans a lot in the Fargo area and across the states. Tell me, do you know? Can you tell me if the Bank of North Dakota helped you finance this small business loan to this particular borrower? And they went through their paperwork and they looked it up in their records and they found out, yeah, actually, the Bank of North Dakota helped us finance this small business loan to this borrower. And the borrower didn't know, and most small businesses don't know that the banks that they get small business loans from in North Dakota are almost always getting help from the state-owned bank in North Dakota to finance those loans.
Yeah. So let's talk about how that works. What is it that the state bank is doing to get these smaller banks the cash to be able to finance these smaller loans for people in the state?
Yeah. So the main structure that the Bank of North Dakota uses is called a loan participation. And private banks do this with each other more than you would realize. In a loan participation, basically, there's one bank that knows the business. It might be a community bank. It might even be a larger bank. But, the business, let's say it requests $1 million loan. And the bank says, well, we can only, because of our constraints, we can only loan you $500,000. In a loan participation, they can bring in another lender behind the scenes. It could be a private lender to provide the other $500,000 that the borrower needs to buy a building or put some solar panels on top of their building or whatever it is. Mm-hmm. And they get the $1 million, and the borrower never realizes behind the scenes that there's more than one lender on this loan because they're only dealing with the one bank that's local to them, the one bank that they know. But that bank is bringing in capital from somewhere else. In North Dakota, you have the Bank of North Dakota that can do that. I mean, in other states, like you mentioned, this happens in other states, in other markets, more frequently than you would realize. But it can be challenging. I've talked with small credit unions in Brooklyn, New York, where there's so many financial institutions here, but the small credit union needed to do a $3 million loan. It had to call around 4 other credit unions before it could get 2 of them to help it cover what the borrower needed. This is in New York City. So think about it in North Dakota. If you didn't have the Bank of North Dakota around to call up and say, look, I need a loan participation. Can you help me out? Because basically that's the Bank of North Dakota's main line of business. It's loan participations. It's got hundreds of loans on its books. It does about 500 commercial loans every year, and those loans are all loan participations. Yeah. Basically, the local bank has to approve the loan first, and then the Bank of North Dakota comes in behind the scenes to help it out. So.
Yeah, and the money that the state bank has comes from the state itself. Like the idea here is that the state is making a public investment, I guess, would be the way to describe it, in this kind of accessibility, to loans, to capital.
Yeah, exactly. I mean, that was the idea way back in 1919, now more than 100 years ago, when basically the farmers in North Dakota were really upset with the big banks in Minneapolis and Chicago that weren't really able to give them loans on terms that they could afford. So they realized, well, we all pay taxes to our state government, and those taxes get deposited into a bank what bank is it? And they said, well, whatever bank it is, we're going to create our own state-owned bank, deposit our tax dollars there, and that bank will then be able to make loans or work with the private sector, private lenders across North Dakota to help those local lenders make loans on terms we can afford as farmers all across the state. And that was the idea back in 1919, and it's pretty much still what happens today. I mean, it's not all farmers anymore. North Dakota's, got shale oil and all kinds of other industries popping up, and it's not just farming, but it is still a lot of farming that happens in North Dakota, and that's a big part of the Bank of North Dakota's business.
Yeah. So it seems to me that there are a couple of instances where this would pay really big dividends. I mean, it of course sounds like a better system to make sure that capital is available to small borrowers, small commercial borrowers, those kind of things. But the two instances I'm thinking of, I'll start with the first, is in the case of financial emergency. So let's go back, for instance, to the Great Crash, now about 16 years ago, and the availability of capital really, was really in jeopardy in most places. It seems to me that if you've got a state bank and it's those state assets that power the financial lending in the state, maybe it's not as dire. The crisis is not as dire as it would be in another state. Is that what happened in North Dakota during the Great Crash?
Yes, but with the confounding variable that right around the time the crash happens, the shale oil industry also picked up in North Dakota.
Okay.
And that sort of became, so it's, it would take economists some time to research and figure out to really know what was more of the driving factor. They could have been equally driving factors, but ultimately, yes, in North Dakota, there was no Great Recession, so to speak, the way there was in the rest of the country. In part because you have a stronger local banking system that's kind of able to pick up the pieces.
Yes.
But that reason it's a stronger local banking system is because you have a state-owned bank that's entirely designed to support a local banking system.
Yeah, it's backing them up.
Yeah, and even with the shale oil industry, one of the reasons that industry was able to scale up so quickly is because the state-owned bank in North Dakota was able to work with the local private lenders to scale it up. It's not just the industry that needs loans, right? For all the workers that got pulled into those jobs in Western North Dakota, someone had to build the housing. Someone had to finance the construction of all that housing. Someone had to finance the home loans to the workers to move into those to those housing units. And guess what? When the rest of the country's housing market was collapsing because Fannie Mae and Freddie Mac and everybody else kind of collapsed, in North Dakota, because you have this stabilizing force of the state-owned bank, it was able to roll right into like, oh no, we can build all the little things you need around the where the shale oil is. You can build it. Now I may not like fossil fuels. I may not like
right. That's another issue.
That's another issue. But it is part of the story of how North Dakota was able to avoid a recession during the financial crisis.
Yeah.
Not only the oil industry growing up there, but the state-owned bank and the local banks being able to pivot into doing all the things you need to scale up an industry pretty quickly.
Yeah, yeah. And then I guess the other instance in which it seems that this would be of particular use is for capital projects that are public in nature. For decades here in the state of Michigan, we have short funded our infrastructure, and it is most evident in the condition of our roads. When they nationally rank, how well states take care of roads, we're almost near the bottom almost every time. Now we're doing a little better right now. We've got a governor who's dedicated more resources to it. But it seems to me that effort would have been easier and would have escaped some of the fighting about where is the money going to come from if, in fact, the state had assets in a publicly owned bank that could finance road construction and things like that.
Yeah, you see that a little. You see a little bit of that in North Dakota.
Okay.
With the Bank of North Dakota, there are infrastructure loan funds that it manages, that it funds. There are infrastructure lending programs that it manages. And, it also makes direct loans to local government units in North Dakota.
Mm-hmm.
At the same time, you do still see North Dakota municipalities issuing municipal bonds, borrowing from the same municipal bond market that everyone else borrows from.
Uh-huh.
I haven't had a chance to look into, how having a state-owned bank has changed North Dakota's or makes it different from other municipal bond markets. The fact that, these local governments have another option besides the municipal bond market to go to.
Mm-hmm.
I can't say I've looked into how that is different in North Dakota. It does make a lot of loans there, and though to local governments in North Dakota. And again, some of those loans are direct, but a lot of those loans, they end up going through community banks too.
Yeah.
And I would also say, again, just to go back to the bigger structural question of like having more community banks around, what would it do?
Mm-hmm.
One of the big things community banks do besides making loans to people and businesses is buying municipal bonds. And if you have more community banks around buying more municipal bonds, those are lenders competing to buy those bonds, and maybe they're going to compete by offering to buy those bonds at a lower interest rate. I mean, this is a whole other dynamic of like having more community banks around. What does it do? Well, part of it is they buy municipal bonds.
Yeah.
And maybe that helps local governments also access funding locally. Also, local governments still deposit some of their funds in community banks.
Mm-hmm.
I actually just looked it up last week. There's maybe around $700 million that state and local governments have deposited in community banks. I mean, that could easily be a lot more. And of course, if those dollars are deposited in community banks, where are they going to invest those dollars? Right where they're located.
Yeah. Okay, we're going to take another quick break, and when we come back, we'll continue this conversation with Oscar Perry Abello about banking and how we improve access to banking in Detroit and Michigan and other places around the country. We'll be right back with more Created Equal. This is Created Equal from WDET in Detroit. I'm Stephen Henderson, and I'm glad you've joined. We're talking with Oscar Perry Abello, a senior economic justice correspondent for the urban magazine called Next City. He's also writing a book about locally owned banking institutions. We're talking about the idea of a state bank, among other things. The North Dakota State Bank has had a real effect on the access to capital in that state. So Oscar, I want to talk about the effect of the current banking system we have, which, as we pointed out earlier, or talked about earlier, has kind of shifted from local community banks to national banks that aren't interested in the kind of lending that, lots of people in communities need to do. I want to talk about the communities that are affected and how it exacerbates inequality.
Right. Yeah. I mean, the access to community banks, even when there were many more community banks around, 30 or 40 years ago, the access to those community banks was never the same, based on race.
In your reporting, what does that tell you about poverty and the cycles of poverty that we think of? In other words, the inescapability of poverty as it affects communities of color.
Well, I want to start by saying the banking system is far from the only factor that keeps or puts families or entire communities into poverty, right? It's not the only thing that matters. But when I look at the banking system, even today, even after all of the consolidation that we've had, we still have 4,140 community banks across the entire country, which is way more than most other countries, right? Like most, Indonesia is the next closest in population to the U.S., and it's got about 1,000 banks across Indonesia. So we're about the same population as Indonesia, but we've got 4 times more banks and way more community banks, right? Because those banks in Indonesia aren't necessarily local. So I'm talking 4,140 locally owned, locally controlled banks in the U.S. But every single one of those banks will tell you the same thing. We lend to who we know, to the communities we know, to the people we know. And the fact is, out of those 4,140 community banks, only 124 are owned by or led by people of color.
Yeah.
So I'm talking less than 1%, right? Oh, I'm sorry. Yeah. No, I'm sorry.
It's less than 10% for sure.
It's like 40, like 3%. Yeah. It's less than 5% of community banks are owned by or led by people of color in the U.S. So you can imagine who has access to those community banks. I don't have the numbers in front of me for Detroit, but I can tell you, like in New York City, we've got about 30 community banks based in New York City. Only one is Black owned. Only one is Hispanic owned. And the city is, basically 25% Black, 25% Hispanic.
Sure.
About 40% white. Like that's insane. That certain communities, based on what they look like, and we know in this country cities are segregated, so based on what they look like and where they live, some people have more access to community banks than others.
Yeah.
And even those white communities, like I mentioned, even those white communities that still have access to some community banks, they have far less access than they did 30 or 40 years ago when there were almost 16,000 community banks across the entire country.
Yeah, yeah. So I wonder if the solution here is led on the community level, where we somehow, get enough capital together to create more banks, owned and operated by people of color to serve communities that look like them. Or do you think that the solution starts more at that state level, like it did in North Dakota? Would it be possible even to start at the community level to expand banking access, given the size and the power of the national banks? I mean, I remember watching in Detroit the local banks that I remembered as a teenager when I first started, banking, just get gobbled up, right? The first place I got a mortgage in the city of Detroit was a little local bank called Standard Federal. That's now part of, I think, Bank of America. Is it even possible to reinvigorate that community level banking without a state bank?
It's got to be both. It may or may not be a state-owned bank. It could be a city-owned bank, or it could be, a more intentionally designed federal banking, a more intentionally designed federally owned bank of some kind. We still have remnants of that back in the day. So, how did we get to have 15,700 community banks in 1985? It was both. At the community level, different communities being able to put together the capital to create their own banks. But every single one of those banks got help from at the federal level, at the very minimum, either from the Federal Reserve or the federal home loan banks, or even federal deposit insurance, right? Like one of the reasons those banks could collect so much, could pool so much in deposits was federal deposit insurance. Giving people the confidence, giving communities the confidence to deposit their savings into these banks. So it's in this country, it's always been both at the community level and at either the state or federal government level for the most part. At the beginning of the country, at the beginning of U.S. history, right after the American Revolution, the first banks that were started, many of them were a combination of public and private ownership. Because where else was the money to start those banks back in the late 1700s, early 1800s? A lot of the startup capital came from the state governments, and they would kind of manage the banks privately, but they would be state owned. We kind of did away with that over time, and we only have one state-owned bank left. But places like Pennsylvania and Tennessee used to have state-owned banks, 100% state-owned. That would be, state-owned but privately run. They would support, mostly private companies in their lending. But there were also hundreds and eventually thousands of little community banks also popping up all over the country. Yeah. It's always been both. And those little community banks, we used to have banking panics all the time, right? Bank runs, people would run to pull their money out of the banks that were failing, until federal deposit insurance. Yeah. When that was put in place in the 1930s, the number of bank failures in the country dropped off dramatically. And it really allowed those community banks to get to work and build the cities we see today. Yeah. Again, it's both, right? At the local level, the community level, but also some kind of public support, whether it comes from the state-owned bank in the case of North Dakota, or the Federal Reserve or federal deposit insurance, or, there's a big fight right now about the federal home loan banks, which are these sort of weird quasi-government kind of wholesale lending institutions. They only make loans to other banks. They've been around since the Great Depression. They were created as part of the kind of New Deal era programs, right, to get the economy going again. There's a big fight right now around what are the federal home banks? Are they still useful? Should we still have them? Because they've been sort of corrupted by big banks over the past several decades. But the point is, it's got to be both, right? It can't just be community. It can't just be federal government. The way we've built most of this country has been through a banking system that is both partly community and local and partly public in some way.
Yeah. The flip side of that question, I guess, is, are the national banks all bad? In other words, do we have too much nationalization of the banking system, and do we need to treat that differently in order to shift more of the focus back to community banking?
I say yes. And the reason I say yes is because when I look at the investment portfolios of banks, every single bank has to report to regulators every quarter what they're investing in. Not specific companies, but the kinds of investments, right? So every bank has to tell federal regulators, how much in bonds have I invested in, stocks, and how many and actual loans, and then what kinds of loans. So like how many loans are for home mortgages, how many are commercial loans, how many are loans for commercial real estate, how many are loans for small businesses in some cases, right? So every bank has to report this. And so I know, for instance, you can look at today, right now, that the biggest four banks in the country, which have a majority of the assets in the system, they have about 40% of all deposits are in the biggest four banks.
Mm-hmm.
They have $9 trillion in their portfolio, and just 42% of that portfolio are actually loans.
Right.
The 4,140 community banks, they have 1.8 trillion, fewer dollars, but 67% of their portfolios are actually loans. And then you can look at the kinds of loans. Community banks have $1.4 trillion in real estate loans in their portfolios. These are loans made for building, acquiring, or maintaining homes, apartment buildings, shopping centers, factories, or even farmland, right? $1.4 trillion community banks have invested in real estate.
Mm-hmm.
The big four banks, I just mentioned, they're much bigger than the community banks combined. The community banks have the same amount of dollars, 1.4 trillion in real estate, even though they're so much bigger. Small businesses, it's even more frustrating, right? Community banks have $223 billion in small business loans in their portfolios. The biggest four banks have just $110 billion in small business loans
Wow,
in their
so
portfolios.
almost half, yeah. And in that I mean, we should be clear. The reason that's true is that the other business that these big banks are in is investment banking on a much larger scale, right? It's their investments in riskier, but also wealthier kinds of investing, and the growth of that has really pinched out home loans and small business loans.
That's right. Basically, the bigger banks are more interested in working with larger corporations and especially other financial institutions.
Mm-hmm.
You know, a lot of these private equity funds that are buying up homes all over the country, including in Detroit, right? They're not buying up these loans with their own cash.
Right.
These homes with their own cash. They're taking out big loans
They're
from
getting
big banks
loans. Yeah.
to buy all these homes.
Yeah.
So the big banks like to work with who they know, and who they know are other financial institutions, other investment banks, other kinds of investors who are just borrowing from the big banks. And I think JP Morgan Chase lost like 138 million on one loan a couple of years ago.
Wow.
But it's no skin off their back because that's not even like 0.1% of their earnings for that year. Like that was nothing.
Yeah. Okay. Oscar Perry Abello, Senior Economic Justice Correspondent for Next City. It was really great to have you here with us to talk about banking in our country. Thanks so much for joining us on Created Equal.
Yeah, thanks, Stephen. Great to be with you. Really appreciate it.
It was really wonderful.
I really liked the question you asked about the national recession and how North Dakota State Bank, the only state bank in the United States, supported their oil industry. I can't remember the name.
The shale industry,
shale oil industry,
which took off during
that crisis.
The recession. They were able to support all the infrastructure that needed to be built for that industry to expand, and they also, he said, they avoided the recession, the Great Recession, which set all the rest of us way back. I mean, people are still picking up the pieces in their financial lives from that. So that's a big difference, I think.
Difference in what that local financial institution can provide as far as support for your entire economy like that. That's something I hadn't thought about.
Yeah. It was a really interesting moment in the interview, and it speaks to the power of this kind of aggregated state capital as a support for local banking, right? And it's not something that I think most people think about. But our caller, Chris, I was thinking about it all the time. I hope he heard today's show because it was absolutely about his issue. That'll do it for us on Created Equal. Be sure to listen to our recent episodes at wdet.org, and we would love if you would subscribe to our podcast, where you can leave us a rating or a review. Created Equal is produced by Carrie Jr. II and David Lyons. Our audio editing is done by Connor Anderson, and the music is by Sam Bobian. Created Equal is a production of WDET, the listener-supported service of Wayne State University.